How much do you know about interest rates? Interest rates are more than just a number. Interest rates affect everything from consumer finances to corporate borrowing, the economy, the stock market, and ultimately your portfolio. Today I'd like to talk about how interest rates are set, why they matter, and what you can do to protect your portfolio from changes in these rates. I'm Curtis Chambers with the Chambers Financial Group. So who determines interest rates? Interest rates are a topic that's always in the news, usually in the context of whether the Federal Reserve should raise or lower interest rates. You may remember when inflation first started to go up, all we heard about was that the Fed did not raise rates quickly enough. And then when unemployment started to rise ever so slightly recently, there's been much speculation about whether and when the Fed would cut rates. When we talk about the Federal Reserve raising or lowering interest rates, what we're really talking about is changing the federal funds rate. The federal funds rate is the rate that banks use to borrow from each other. The federal funds rate is set by the FOMC, or the Federal Open Market Committee, which is part of the Federal Reserve. The key thing to understand is that the federal funds rate mainly affects short-term rates, such as short-term loans that banks make to each other and to credit card companies. Longer-term rates are set by the market. If you think about it, we don't know what interest rates will be in a year, let alone in 5 years, or 10 years like in a 10-year government note, or 30 years like in a mortgage or a 30-year municipal bond. Therefore, these rates aren't set by the Fed. They can't be. They're set by the market through supply and demand. So why do interest rates matter so much? The answer is the domino effect. Changes in the Fed rate impacts almost everything. Mortgages, loans, car payments, investment portfolios are all affected. Rate changes essentially have a direct effect on consumer expenses, investments, and corporate spending. To see why this is so, let's take a look at an example. What does a 1% reduction in interest rates mean? Let's say someone is buying a house for $350,000 and putting $20,000 down. They get a 30-year mortgage locked at 7%. Their monthly interest payment would be about $1,846. Now imagine that interest rates decline by 1%, allowing them to get the same $350,000 house with the $20,000 down payment, but at a 6% mortgage. Their payment would then be $1,664, saving them $182 per month on their mortgage payment. Over 30 years, that would equate to a $66,000 savings. So let me share a personal story from when I first figured out the importance of interest rates. I was a young teenager back in 1979, and I went with my father, who was going to buy a car. Of course, I liked the car and urged him to buy it. I was all excited. He negotiated, but he left without making the purchase. Later, over coffee, he explained to me that interest rates were so high at the time, around 14%, that even though he liked the price, financing the car would mean he would primarily be paying interest on the loan. So he didn't go through with it. Contrast that with the more recent years, like the decade before COVID, when you could get car loan interest rates as low as 2% or even 1%, and sometimes 0. You can see how the affordability of the car changes, not because of the price, but because of the rates. So what happens when interest rates rise? Rising interest rates make borrowing more expensive. When things become more expensive, individuals are likely to buy less. Less homes, less cars, and corporations will also invest less and spend less, putting less into equipment, expansion, factories, employees, and R&D. This reduced spending slows the money flow into the economy, reducing economic growth and potentially lowering stock prices as companies earn less money. It's important to remember that when the Fed raises interest rates, they often do so to cool down inflation. The economy is like a car engine, and the Fed aims for it to run quickly and fast, but not overheat. When it starts to overheat, they raise interest rates to stabilize prices, even if it may reduce growth. And what about when interest rates fall? Well, when interest rates decline, borrowing becomes cheaper, encouraging spending on homes, cars, and corporate investments. This boost in spending stimulates economic growth and can potentially lead to gains in the stock market. One thing to remember is that there is a lag time. If interest rates decline, it doesn't immediately impact the economy. It can take up to 18 months to 2 years to see the full impact. However, the stock market often looks ahead, sometimes a year or more, and may already be anticipating these improvements in advance. So what are some action items, some takeaways? What should you do next? Well, first, review your portfolio to understand how rising and falling interest rates can impact your stocks, bonds, and other assets. Manage debt as interest rates start to decline. Consider refinancing mortgages or consolidating debt when rates drop further. Be sure to diversify your investments. A mix of different assets can help manage the risk tied to rate changes. Stay informed about Fed actions and interest rate behaviors. And remember, a financial advisor can guide you through these changes and help you make informed decisions. Interest rates play a huge role in the economy, your wealth, and your financial future. Stay informed, make adjustments when needed, and always plan for what's best for you and your family. Thanks for watching. I hope you've learned something about interest rates. If you found this video helpful, please don't forget to like and share and subscribe.